Have you ever wondered why some traders seem to anticipate market moves with uncanny precision, while others are constantly caught on the wrong side of major price swings? What if I told you that the secret might be hiding in plain sight, within a dimension of market analysis that most traders consistently overlook? When you look at a price chart, you're only seeing half the story, like watching a movie with the sound turned off. You can follow the plot, but you're missing crucial emotional cues, the intensity of interactions, the building tension before climactic moments. In trading, this missing dimension is volume, and understanding its language might be the difference between consistent profits and persistent losses. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Think about it. Has this ever happened to you? You spot what looks like a perfect technical setup, the price breaks out above resistance, you enter your position with confidence, only to watch the market reverse sharply, stopping you out for a loss. Stay with me until the end, because what you're about to discover might completely transform how you interpret these market movements. Richard Wyckoff, one of the pioneering giants of technical analysis, recognized over a century ago that price alone was insufficient to truly understand market dynamics. He saw volume as the fuel that drives all significant price moves, a direct measurement of the energy, intensity, and conviction behind the actions of buyers and sellers. At the heart of Wyckoff's volume analysis lies his fundamental law of effort versus result, a principle so elegant yet powerful that it continues to give traders an edge in today's markets. This law states that for every action in the market, there is a reaction, and the nature of that reaction can reveal the underlying balance of power-shaping price movements. Imagine volume as the effort being applied to move price, like pushing against a spring. Sometimes, a small effort produces a dramatic result, showing tremendous underlying strength. Other times, a massive effort produces barely any movement at all, revealing hidden resistance. These relationships between effort and result, whether in harmony or discord, provide reliable clues to the market's future intentions. What makes this approach so powerful is that it allows you to see beyond the obvious price action into the invisible hands driving the market. You begin to recognize the footprints of major institutions and market professionals, what Wyckoff called the composite man, as they accumulate or distribute positions before major moves. The fascinating aspect of volume analysis is how it transforms seemingly random market fluctuations into logical, almost predictable patterns. If you want to continue mastering the markets with these advanced trading concepts, hit that subscribe button now. I release new strategy breakdowns every week to help you see what others miss. When you understand how to read these patterns, a profound transformation occurs in your trading journey. The market begins to reveal its hidden truth, that behind seemingly random price fluctuations lies a logical structure driven by the decisions of informed operators. Let me show you what I mean by exploring the concept of harmony between effort and result. This alignment is the foundation of reliable market analysis. When a stock advances on expanding volume, we're witnessing a beautiful synchronicity. The effort, increasing volume, perfectly matches the result, rising price. This harmony confirms the strength of buying demand and suggests the trend is likely to continue. It's the signature of a healthy, sustainable market, movement that you can trust with your capital. Imagine watching a sprinter accelerate. As they apply more force with each stride, their speed increases proportionally. The relationship makes intuitive sense. Similarly, When volume and price move in concert, the market is telling you a coherent story about its underlying strength. This revelation alone can save you from countless false breakouts and premature exits. But here's where it gets fascinating, and where most traders miss the most valuable signals. The most critical insights often come not from harmony, but from disharmony. When effort and result are out of sync, the market is revealing something profound about its true condition. Picture this scenario. A stock has been rising steadily for months. Suddenly, it experiences a day of enormous volume, perhaps 3 or 4 times the average, yet the price barely moves higher or even closes lower than it opened. This dramatic disconnect between the massive effort, volume, and the minimal result, price progress, is a major red flag. Behind the scenes, what's actually happening is that strong buying from the public is being met by equally strong or even stronger selling by informed interests. This is the classic signature of distribution, where the composite man, Wyckoff's term for the collective actions of smart money, is methodically feeding his accumulated position into the excited hands of an uninformed public. While retail traders see high volume as confirmation of strength, the seasoned Wyckoff analyst recognizes it as a warning of impending reversal. The impact of understanding these subtle relationships cannot be overstated. It's like developing a sixth sense for market dynamics that most participants never perceive. You begin to see through the market's misdirection and identify the underlying reality of supply and demand. Now, I want to go even deeper into this topic by exploring exactly how volume behaves at key market turning points, and how you can use these insights to position yourself alongside professional traders rather than against them. If you're starting to see markets in a new light after understanding these volume relationships, write in the comments, "Volume tells the real story." One of the most profound revelations in Wyckoff's approach is understanding volume as a direct measure of the eternal battle between supply and demand. High volume isn't just activity, it represents significant interest and urgency. From market participants, it reveals a fundamental disagreement about a stock's value, with both buyers and sellers acting with strong conviction about their position. Think about the psychology behind these high-volume periods. When you see sustained, elevated trading activity, you're witnessing a clash of mindsets. The believers who see value and opportunity facing off against the skeptics who perceive risk and overvaluation. This conflict creates the perfect environment for price discovery, and more importantly, for savvy operators to execute their strategies behind the scenes. Consistently high volume is particularly telling because it indicates that large operators, the institutional players with the capital to move markets, are actively participating. This is a crucial insight that transforms how you interpret market activity. The composite man, representing the collective actions of informed money, simply cannot accumulate or distribute significant positions without generating enormous trading quantities. Their footprints become visible through this volume signature. It's like watching the tide at the beach. When you see unusual water movement and churning waves, you know powerful currents are at work beneath the surface. Similarly, when you observe persistent high volume, you can be confident that significant forces are reshaping the market landscape, even if the price hasn't yet reflected these changes. But here's a critical distinction that separates amateur volume analysis from professional insight. Volume must always be considered in relative, not absolute terms. The journey to mastering this aspect requires developing a contextual understanding that goes beyond simple numbers. What truly matters isn't the raw volume figure, but rather the change from the established norm. A sudden increase from dullness to activity, or a shrinkage from activity to dullness. These transitions signal potential shifts in the supply-demand balance. They serve as early warning systems, alerting the analyst to look for further evidence of new market movement. This is just one piece of the trading puzzle. Subscribe to the channel for more in-depth market analysis that goes beyond the obvious and reveals what's really happening behind the charts. This relative perspective requires a more nuanced mindset. Instead of being impressed by 1 million shares trading in a blue-chip stock, you learn to be more intrigued by the normally quiet small cap that suddenly trades 3 times its average volume. The departure from the established pattern is what contains the valuable information about changing market dynamics. Behind the scenes, these volume shifts often precede visible price movements. The informed operators begin their campaigns quietly, gradually increasing their activity until it becomes noticeable in the volume patterns. By the time the price begins its significant move, those who understand these volume signatures have already positioned themselves accordingly. Let's now examine how the character of volume, not just its quantity, provides additional layers of insight that can further refine your market analysis and timing. If you've ever noticed unusual volume before a major price move, type in the comments, "I've seen the volume signal." The character of volume, its quality rather than just its quantity, reveals another dimension of market wisdom that Wyckoff mastered through his technique of tape reading. In his era, before electronic charts, traders would watch the ticker tape, analyzing trades as they occurred moment by moment. This granular perspective offered powerful revelations about who was driving market action. What Wyckoff discovered was that the size of individual trades printed on the tape provided a window into the identity of the participants. Large lot trades, transactions of 1,000 shares or more, almost always signified the activity of professional operators. The average retail trader simply didn't have the capital to trade in such sizes. Meanwhile, small lots of 100 or 200 shares typically represented the collective actions of the public. This distinction is critical because it transforms how you perceive market activity. Rather than seeing an anonymous mass of transactions, you begin to discern a conversation between different classes of participants, a dialogue between the informed and the uninformed, the patient and the impulsive, the strategic and the reactive. Imagine standing in a crowded room where you can instantly tell which conversations are between industry experts and which are between novices. The experts speak with authority, make decisive moves, and control the narrative. This is precisely what tape reading allowed Wyckoff to do: distinguish between smart money operations and public reactions before these dynamics became obvious on price charts. The journey to this level of market perception requires shifting your mindset from focusing solely on price to embracing the hidden truth revealed by volume character. It's about developing the ability to see beneath the surface, recognizing the footprints of major players who move deliberately and with purpose. This insight becomes particularly powerful when we examine market bottoms, where one of the most dramatic and revealing volume signatures often appears: the selling climax. Picture a market that has been declining relentlessly. Fear permeates the atmosphere. Negative headlines dominate financial media. Suddenly, the selling intensifies into a final convulsive wave of panic. On the chart, this manifests as a day with exceptionally wide price range and, crucially, a massive surge in volume that dwarfs previous activity. To the untrained eye, this looks terrifying, the ultimate confirmation that things are falling apart. But the Wyckoff analyst sees a profound revelation unfolding, a massive transfer of ownership from weak, fearful hands to strong, informed hands. What's actually happening behind the scenes is that the composite man, representing smart money, is using public panic as an opportunity to acquire enormous quantities of stock at bargain prices. While headlines scream disaster and retail investors capitulate, professional operators are quietly accumulating positions that will form the foundation for the next bull market. This understanding creates a complete transformation in how you approach market bottoms. Instead of being paralyzed by fear, when everyone else is selling, you develop the confidence to recognize potential accumulation phases and position yourself accordingly. The intensity of the volume becomes not a warning to flee, but potentially a signal to prepare for opportunity. Let's explore how this accumulation process continues to unfold after the initial selling climax, revealing further volume signatures that confirm the change in market character. If you've ever watched a market bottom with massive volume and wondered what was really happening, drop a comment saying, "I've witnessed the transfer." After the initial shock of the selling climax and the subsequent automatic rally that naturally follows, the market enters a crucial phase in its evolutionary journey, the accumulation range. This is where the true test of character begins, both for the market and for you as an analyst. The dance between buyers and sellers becomes more subtle, requiring a deeper level of perception to interpret correctly. The key, confirmation that accumulation is truly underway, comes in the form of the secondary test. This is when the price drifts back down to test the low point established during the selling climax. What happens with volume during this test is absolutely critical. It must show a dramatic reduction compared to the climax. This shrinkage in volume is the market whispering a profound revelation. Selling pressure has been exhausted. Think about the psychological transformation taking place. The fearful sellers who were desperate to exit during the climax are now gone. Their position has been absorbed by patient, informed operators who have no intention of selling at these prices. This creates a vacuum of supply that sets the stage for the next advance. Throughout the entire accumulation range, this pattern should continue to unfold. Volume progressively lightens on downward reactions, confirming the absence of selling pressure, while expanding on rallies, showing the presence of buying interest. It's like watching a battlefield where one army is gradually depleting its ammunition while the other is steadily reinforcing its position. Behind the scenes, what's actually happening is a methodical transfer of ownership. The composite man is quietly absorbing all available supply, preparing for the eventual markup phase. This process can take time, weeks or even months, as patience is a virtue that separates professional operators from amateur traders. As the accumulation campaign nears its conclusion, the composite man often employs one final test of supply, a manipulative maneuver known as the spring or shakeout. This is where the mindset difference between informed and uninformed participants becomes starkly apparent. The spring is a sharp thrust below the support level of the trading range, designed to mislead the public and flush out any remaining weak holders. It creates the illusion that the support has failed and that lower prices are imminent. The volume signature during this maneuver tells the real story. A spring on conspicuously low volume is one of the most powerfully bullish signals in the entire Wyckoff methodology. It reveals the hidden truth that sellers are completely gone. The composite man has pushed price into territory where one would expect to find a wave of stop-loss selling, but instead encounters a vacuum. This absence of supply confirms that the stock is primed for advance. Alternatively, a spring on high volume that quickly reverses back into the trading range is equally bullish, though for a different reason. In this case, the break below support did trigger a final wave of selling, but the composite man's buying power was sufficient to absorb all of it. The rapid recovery proves that demand has overwhelmed supply. Both scenarios represent the final confirmation that the accumulation process is complete. The stock has been successfully transferred from weak, uninformed hands into strong, patient hands. The foundation has been laid for the next phase of the market cycle. Let's now examine what happens when the stock finally breaks out of its accumulation range and how volume confirms the validity of this crucial transition. If you've ever been shaken out of a position right before a major move higher, type in the comments, "I've felt the spring." After the meticulous accumulation phase has been completed, the market reaches a pivotal moment in its journey, the breakout above resistance. Wyckoff referred to this as the jump across the creek, a vivid metaphor that captures both the significance and the inherent risk of this transition. But how can you distinguish between a genuine breakout that launches a powerful new uptrend and a deceptive move designed to trap unwary traders? The answer lies in the volume signature. A valid, trustworthy breakout must be accompanied by a substantial increase in volume. This is non-negotiable in Wyckoff's methodology. The high volume represents an unmistakable confirmation of powerful demand entering the market. It reveals the hidden truth that multiple forces are converging simultaneously. The composite man actively bidding prices up, other professional traders recognizing the technical signal and participating, and trapped short sellers being forced to cover their positions. This surge in trading activity creates the necessary energy to overcome the natural resistance that exists at the previous ceiling of the trading range. It's like watching a rocket launch. The initial escape from Earth's gravity requires tremendous thrust. Similarly, a breakout needs significant volume to escape the gravitational pull of the previous trading range. The revelation here is that breakouts occurring on low or merely average volume should be viewed with extreme skepticism. Such moves often represent upthrusts or bull traps, manipulative maneuvers designed to lure uninformed traders into poor positions before reversing course. The lack of confirming volume exposes the absence of genuine conviction and demand. This insight alone can transform your decision-making process and protect your capital from one of the most common pitfalls in trading: chasing false breakouts. By simply adding volume analysis to your breakout strategy, you dramatically increase your probability of success. Once a valid breakout has occurred and the markup phase begins, volume continues to tell a crucial story about the health and sustainability of the advance. A robust uptrend has its own distinct rhythmic signature. The volume should expand on advances and contract on reactions. As the stock pushes to new highs, the volume should increase, confirming that buying enthusiasm remains strong. This demonstrates that demand is easily overcoming any profit-taking or natural resistance. The harmony between rising price and rising volume reinforces that the trend remains in a powerful technical position. Equally important is what happens during pullbacks or corrections. On these downward movements, the volume must noticeably shrink. This contraction in volume during declines is perhaps the single most important indicator of a healthy trend. It proves that the selling is not aggressive distribution from large operators, but simply passive profit-taking from weaker hands that is easily absorbed. This volume rhythm creates a framework for maintaining conviction through the inevitable fluctuations of an uptrend. It provides logical, evidence-based criteria for distinguishing between normal, healthy corrections and potentially dangerous reversals. As long as this pattern persists, expanding volume on advances and contracting volume on pullbacks, you have solid justification to maintain your position and let your profits run. The impact of recognizing these patterns extends beyond individual trades to your entire market mindset. You develop the confidence to stay with winners longer, avoiding the common mistake of cutting profits short while letting losses run. Let's now examine what happens when this healthy rhythm begins to change, and how volume provides the earliest warnings that distribution may be taking place. If you've used volume to confirm breakouts in your own trading, drop a comment saying, "Volume validates my entries." Just as markets have beginnings, they also have endings, though not random or unpredictable ones. The same methodical patience that informs accumulation at bottoms also governs distribution at tops. The market's cyclical journey reveals its intentions through volume signatures that signal when bullish trends are exhausting themselves and a transformation is imminent. The most dramatic volume signature of a major market top is the buying climax, the mirror image of the selling climax we discussed earlier. This phenomenon emerges when public enthusiasm reaches a fever pitch. The psychological landscape is dominated by greed rather than fear. Financial media broadcasts universally positive news. The fear of missing out drives the last wave of uninformed buyers into the market in a final frenzied rush. This moment represents the ultimate opportunity the composite man has been patiently waiting for. He now meets this euphoric demand with massive supply, feeding his accumulated position, acquired at much lower prices, into the eager hands of the public. The revelation on the chart appears as a day of extremely wide price spread, coupled with exceptionally high, often climactic volume. A critical insight here is what happens to price action during this session. The stock typically surges to a new high early in the day, creating excitement, but then stalls and closes well off its peak. This price behavior represents the ultimate disharmony between effort and result. The tremendous effort, climactic volume, fails to produce a corresponding result, a strong close. This failure to hold gains proves that buying demand, as powerful as it was, met and was overwhelmed by an even stronger wave of selling supply. Behind the scenes, this marks a profound shift in market dynamics, a massive transfer of ownership from strong, informed hands to weak, emotional hands. The buying climax signals the exhaustion of market buying power and serves as the first serious warning that the uptrend is in jeopardy. Following this climax and the subsequent automatic reaction, the stock enters a distribution trading range. The volume signatures within this range are the inverse of those seen during accumulation. Most tellingly, volume expands on declines within the range and contracts on rallies. This reversed pattern reveals a complete change in character. Supply is now dominant over demand. When volume increases during sharp drops, it shows that supply is becoming aggressive. The composite man is actively pressing his sales. Conversely, when the stock attempts to rally back toward the range highs, volume becomes conspicuously light. This drying up of volume on rallies is a critical warning sign, proving that genuine professional demand has vanished. The buying power is exhausted, and the public lacks the financial capacity to absorb the large blocks being offered. Another key insight during distribution is the repeated failure of the stock to make significant upward progress despite high volume. The price may churn dramatically near the range top, showing great activity, yet fail to advance. This represents another clear manifestation of effort-result disharmony. The high volume, effort, produces no upward movement result. This churning action is the very essence of distribution, a methodical transfer of holdings from informed to uninformed participants. Let's explore how this distribution process culminates in a final manipulative maneuver designed to trap the last remaining bulls before the markdown phase begins. If you're starting to recognize these distribution patterns in current market conditions, comment below, "I see the churning action." As the distribution campaign nears its conclusion, the composite man often employs one final deceptive maneuver to extract maximum value before the downtrend begins: the upthrust. This is the mirror image of the spring we discussed earlier, but with an inverse purpose. Where the spring is designed to shake out weak holders at the bottom, the upthrust aims to trap over-eager bulls at the top. The upthrust manifests as a sharp price move above the resistance line of the trading range. Its purpose is brilliantly manipulative to create a final illusion of strength that encourages breakout buyers to jump in while simultaneously triggering the stop orders of any remaining short sellers. This confluence of buying provides the composite man with the perfect opportunity to sell his final positions at the most advantageous prices. The volume signature on the upthrust reveals its true nature and intention. An upthrust that occurs on conspicuously low volume is an immediate red flag. The lack of substantial volume proves there is no genuine demand behind the move. It's merely a technical maneuver designed to create the appearance of strength where none actually exists. Even more telling is an upthrust on high or climactic volume that fails to produce any further upward progress. This shows that the breakout attempt encountered overwhelming supply, so much selling pressure that even the substantial buying from breakout traders and short covering couldn't overcome it. This revelation exposes the hidden truth that large operators are aggressively distributing stock. The confirmation of the upthrust comes when the price swiftly fails to hold its gains, quickly falling back into the trading range. This decisive failure is one of the most reliable signals to exit all long positions and consider initiating short sales in anticipation of the impending downtrend. It represents a profound transformation in market character that the astute analyst cannot ignore. Once the distribution phase is complete and ownership has been successfully transferred from strong hands to weak hands, the path of least resistance becomes definitively downward. The markdown phase begins with the breakdown, what Wyckoff called the fall through the ice. The volume signature here must be examined with the same care as at all other transition points. A valid breakdown must be accompanied by a significant and sustained increase in volume. This expanding volume shows that sellers are now aggressive and that there is a powerful force behind the new downtrend. This harmony between falling price and rising volume confirms the bearish case. A breakdown that occurs on light volume is suspect and may simply be another manipulative shakeout. Following the initial breakdown, there is typically a rally back to the underside of the old support level, which now functions as resistance. Wyckoff referred to this as the last point of supply. The volume signature on this rally provides the final confirmation of the new downtrend. A test of the broken support on light, diminishing volume is extremely bearish. It proves that buying power has been exhausted and that demand is insufficient to push price back into the old trading range. This point offers one of the safest, lowest risk opportunities to initiate a short position. The risk is clearly defined and the probability strongly favors further decline. During the subsequent downtrend, volume continues its role. As the market's truth-teller, a healthy downtrend displays the same rhythmic signature as an uptrend, but in reverse. Volume expands on the declines and contracts on the rallies. The increasing volume on downward moves confirms that selling pressure remains dominant, while the feeble low-volume rallies show that there is no significant buying demand to impede the decline. As long as this pattern persists, the analyst has logical justification to maintain short positions until the first signs of a selling climax and accumulation begin to appear at the bottom. Let's now integrate all these volume insights into a comprehensive framework for market analysis that ties together the entire cycle from accumulation through markdown. If you've ever spotted an upthrust trap before a major decline, type in the comments, "I've dodged the bull trap." As we've explored throughout this journey into Wyckoff's volume analysis, what initially appears as random market fluctuation reveals itself as a logical, almost predictable cycle when viewed through the proper lens. Volume truly is the voice of the market, telling us not just what is happening, but why it's happening and what's likely to happen next. The beauty of Wyckoff's methodology lies in its timelessness. Despite being developed nearly a century ago, these principles remain remarkably effective in today's markets because they're based on unchanging human psychology, the eternal dance between fear and greed, between informed and uninformed participants. By integrating volume analysis into your trading approach, you gain the ability to see market dynamics as the composite man sees them. You begin to recognize accumulation before the markup, distribution before the breakdown, and develop the confidence to position yourself accordingly. This transformation in perspective doesn't just improve your trading results, it fundamentally changes how you perceive market movements. I've thoroughly enjoyed sharing these insights with you today. If you found value in understanding how volume predicts future price moves, I'd love to have you join our community of serious market students. Hit that subscribe button to continue this journey of market mastery together. If you've made it all the way through this deeper exploration of Wyckoff methodology, drop a comment saying, "Volume tells the story." I'd love to know who's dedicated enough to absorb these more advanced concepts. And if you appreciated these insights, a simple like on this video helps tremendously in sharing this knowledge with others who might benefit. Right next to this video, you'll see my analysis of Wyckoff's price action techniques that perfectly complements what we've covered today. Click there and continue building your market understanding, because the combination of price and volume analysis is truly where the magic happens. Until next time, remember that the market always leaves clues. You just need to know how to read them.